Welcome everyone to the latest edition of the Shaw & Partners monthly video update. Believe it or not, it's the middle of November, the weather is getting warmer, the evenings are lighter for longer, and yep, Christmas is just around the corner. And how fast has this year flown past us? The good news is that despite plenty of volatility, it's been a good year to be invested in a financial market portfolio. And certainly after we watched that sell-off after Liberation Day back in April, it's pleasing to see where we are now. And look, October certainly didn't disappoint in terms of share market returns. And just looking at those, the world index in New Zealand dollar terms rose 3.7%. That is a very solid number. The S&P 500 up 3.8%, the Nasdaq 4.8%. Now, New Zealand dollar returns were lifted by the fact that the currency was quite a bit weaker. That was a notable feature of the month that has continued into November. The local share market gained 1.9% and actually outperformed the Australian market. It only lifted 0.4%. Now, what I do want to stress is that we are now looking at really, really healthy one-year returns. When I look at it in New Zealand dollar terms, I look across the different markets, I'm seeing returns of 15, 20, up to 40%. And long years of experience tell me that the next 12 months will probably deliver more moderate returns. And it's really hard right now not to highlight the continued prominence of momentum in AI-related companies. And probably no surprise that if I look at the US market, information technology was the best performing sector, up 6.2% and almost up 30% for the year. The Bloomberg Mag 7 index gained just under 5%. And we're still seeing what we refer to as the concentration story in the US share market landscape. Few companies dominating it. That's a medium-term theme that we are keeping a close eye on because that concentration tends to change over time. But look, it's not just the AI theme supporting US stocks. We've just been through the US third quarter earnings season, and we always look to earnings as being a sort of a pretty fundamental contributor to our overall investment view. And strong and growing earnings are supportive of a rising share market. And certainly third quarter earnings produced a very strong earnings growth rate. It was over 13%. But here's the thing. While earnings are good, the expectations of future earnings are getting quite elevated. And what the US market is arguably what we call price for perfection. So companies really do need to deliver strong numbers in many cases to support what are pretty optimistic expectations. Look, and right now I'm hearing this question all the time. Is there an AI bubble? Is this another repeat of the 1998-2000 dot-com boom and bust? Well, look, there are certainly pockets of euphoria and some eye-watering valuations, particularly in some of the unlisted companies. But look, there are some differences this time. And yes, I'm aware of the old cliche that this time it's different, but the mega cap listed companies investing hundreds of billions of dollars into AI and AI-related areas are well-capitalized companies with incredibly strong franchises and in many cases, lots and lots of cash on their balance sheet. So look, if there is the inevitable dampening of enthusiasm, valuations could certainly moderate, and that would be reflected in share market prices. But those bigger mega-cap companies, they're very well placed to carry on. Look, from our point of view, for us, an appropriate response at the moment is to ensure that investment portfolios are well diversified. Look, it was also, over the course of the month, pleasing to see some easing of US-China trade tensions, although we expect this to remain a work in progress. And while those tensions have eased, they certainly haven't disappeared and they could resurface or flare up at any point. What was evident during the month was a big lift in emerging markets. Now, the Global Emerging Markets Index lifted 7.2% in October. That's a big move, and it was particularly evident in those jurisdictions that have semiconductor businesses like Korea and like Taiwan. Well, what about our local market? Look, well, returns from the New Zealand share market do continue to be a little bit lackluster when compared to other markets. I do think, though, that over the month, we did get a little bit more constructive on the health of the local economy. Now, I've done one thing in the last few months. I've stepped back from using the term green shoots. We've been talking about green shoots since 2024, and in many cases, the green shoots have withered and failed to prosper. So I'm championing the search for flickers in the embers that are our current economic fire pit. I mean, flickers, they can come and go, but if you get enough of them, you can really start to feel the heat. And look, they are evident. I keep a close eye on things like building consents. The last 3 months, we've seen them continually improving, and recent New Zealand company announcements have also contained promising language. Freightways, Port of Tauranga, SkyCity, and only yesterday, Don Braid from Mainfreight was quite definitive and believed they were seeing better numbers with long-term established customers lifting their levels of business. That's a good sign. Look, we aren't seeing a surge, but what we are seeing is just a gentle lifting in activity, and I think we can expect a better economic environment in 2026, but I would also suggest we keep our expectations in check. The recovery, when it comes, will be patchy, unlikely to be frothy. The Reserve Bank, though, has continued to drop the official cash rate. In October, they moved the rate by 50 basis points. People's called a jumbo cut, and that's a measure we really had hoped they would take, and they have signalled that a further 25 basis point cut could bring the rate down to 2.25% by the end of the year. That's good news. Look, falling wholesale rates, what that means is that local fixed interest products have delivered really pleasing returns over the last 12 months. But to a large degree, that move has probably played out. And current rates of return for what I would call mainstream interest rate products in New Zealand are now delivering very modest returns, and particularly when you consider the return after tax and after inflation. What we continue to reiterate is this is a very dynamic macroeconomic backdrop, and our role is to react to that from an investment perspective, and that's still very much the case. We've kept our asset class positioning consistent. We're slightly still favouring growth assets, evidenced by an overweight exposure to domestic listed property and a little bit of a bias to Australasian equities. And we're tending to highlight global funds with diversified exposures and continuing to be a little cautious in the short term around exposure to the Magnificent Seven companies. And look, we're now very focused on managing that global equity exposure of our portfolios, and at some point, we believe that some focus should shift away from US megacap and into other global equity sectors, and that's an active discussion we're having right now. Look, as I said, it's getting quite hard to find value in domestic fixed interest, and we may look to go a little underweight in our exposure there, and we are actively considering global fixed interest as an alternative. But look, end of the day, financial markets are delivering attractive returns. And if you'd like some guidance in how to participate in financial markets, consistent, of course, with your investment objectives and your risk tolerances, why don't you get in touch with us? And we can help you navigate what are now quite challenging markets. Also, we can bring our decades of experience to assist you in providing for your financial future. As always, you can look us up on shoreandpartners.co.nz or on Facebook, LinkedIn. We'd love to hear from you.